Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Suhail and Qureshi, student of Business Administration at SUCL campus Larkana. Today I am going to present my four topics of subject corporate finance, which are assigned by Ms. Shagufta Salim Sheikh. So my first topic for the subject of corporate finance is Introduction to Corporate Finance. So corporate finance is a study of financial decision making in business organizations. It is concerned with the efficient and effective management of the finances of an organization in order to achieve the objective of the organization. Or we can say that corporate finance is the division of finance that deals with the how corporations deal with funding sources, structuring, and investment decisions. So capital structuring means how much capital, cash flow, and cash outflow are there in the organization. So every decision made in the business has a final implications, and any decision that involves the use of money is a corporate finance decision. So for suppose we use a capital in the organization. For that we first made a decision that how financial decisions helps for the capital structuring. Corporate finance manages short-term and long-term decisions that affect operations. In addition to capital investment, corporate finance deals with sourcing capital. So corporate finance is primarily concerned with maximizing shareholder value through long-term and short-term financial planning and the implementation of the various strategies. Corporate finance deals with the financing, capital structure, and money management to maximize returns and shareholders' value. Now the main areas for corporate finance are corporate finance has three main areas of concern. So number one is capital budgeting. What long-term investment should be firm take? Means capital budgeting and the capital structure. What will the firm get the long-term financing to pay for its investments? Also, with what mixture of a debt and equity should it use to fund operations? And number third is working capital management. How should the firm manage its everyday financial activities? Now the importance of corporate finance. The main aim of a corporate finance is to increase the shareholder value that help the managers to be able to balance capital funding between investments in projects and it increase the long-term profitability and sustainability of a company. So corporate finance is primarily concerned with maximizing shareholder value through long-term and short-term financial planning and implementing of various strategies. Now my second topic is time value of money. So time value of money is a concept that money you have now is worth more than the identical sum in the future. So time value of money is can be defined as a rupee is in hand is worth more than tomorrow. So due to its potential earning capacity, this core principle of the finance holds that provided money can earn interest, any amount of money is worth more than sooner it is received. So time value of money is an important concept to investors because a dollar on hand today is worth more than a dollar promised in the future. Like that, we have a rupee in hand is worth more than a tomorrow or after in 5 years. Now the time value of money is is difference between an amount of money in the present that there's the same amount of a money in the future. Having money now is more valuable than having money later. Or we can say the present amount is called the present value, the future amount is called the future value. And the appropriate rate that relates the two amounts is called a discount rate. So present value is equal to, there is a formula for present value. So present value equal to future value divided by 1 plus discount rate, or we can say that interest rate, and whole power n. N shows here the number of years or period of a time. And formula for the future value is equal to present value multiplied by 1 plus I whole power n. So the same is present value, or we can say the principal amount, and 1 plus discount rate is equal to interest rate. and n shows the number of years, how much time that we we give. Now here is an example for the time value of money. So now let's look at the time value of money example. If you invest 100, or we can say that 100 is our present value. For 1 year at a 5% interest rate or discount rate, that at the end of year you would have to 105 the future value. So our present value is 100 and future value is 105 after 1 year. So according to this example, 100 today is worth than 105 a year from today. So the formula for the present value is equal to future value. The future value is 105 and present value is 100, so we can multiply it 1 plus I 1 plus I oh, 1 plus I. So 5% interest rate for finding a 5% we can get we to change it 5% we can change it into decimals. So we first 5% we 5% we can divide with the 100, so we can get the interest rate. That 5% change in decimal is 0.05. So the another in present future value, so 100 is our present value and equal to future value divided by 1 plus I all power n. So now here our future value is 105 and divided by 1 plus I we can get it. Likewise 100 a year from today is a discounted back at 5% is worth only 95.24 today, and 90 and future value we can get this 95.24 equal to 100 divided by 1.05. Now the third topic is accounting and economic profit. Now profit is the most important indicator of the financial health of a company. A company that is not earning a profit is not likely to survive in long term. Absolutely, if any company does not earn a profit, so how he can run? First of all, every company is motto to earn a profit. Or any firm is only motto to earn a profit. There are different meanings of profit as well as that are relevant to different stakeholders. Two such concepts of profits are accounting profit and economic profit. So now accounting profit can be defined as accounting profit is, or we can say that it is a net income or the bottom line of a company. So a company calculates the accounting profit either quarterly or annually or both. Typically, accounting profit or net income is reported on a quarterly and annually basis, and now it is used to measure the financial performance of a company. Accounting profit is used to be measure the financial performance of a company, how much there is, how much capital or finance in a company, the cash flow and inflows and outflows of a cash in company. So the cost and expenses that are used in the calculation are explicit costs of running or operating the business. The costs are expenses that go into the calculation of the accounting profit are raw material, labor costs such as wages, production costs such as labor's production costs, raw materials, transportation costs, and sales and marketing costs, and etc. So, or we can say the accounting profit, also known as the net income for a company or for the bottom line. It is the profit after various costs and expenses are subtracted from the total revenue or total sales, as established by general accepted accounting principle. So here is so accounting profit is the amount of money left over after deducting the explicit cost of a running of a business. Explicit costs are merely the specific amounts that a company pays for those costs in that period. For example, here is an example of wages. Now the economic profit. So the concept of economic profit is not very different from the accounting profit, as it also makes use of explicit cost. Additionally, it takes into account the opportunity cost as well. So opportunity cost is the income that a business could make from the second best use. Means opportunity cost is a foregone cost, or we can say that leave a first choice for second one, which is the best alternative for everyone. So the second best use of available resources. A simple example of opportunity cost is a company that reinvests money in the business forgoes the interest it may have earned by depositing it in a bank. Thus interest is the opportunity cost here. Or we can say that the economic profit is a profit that a business makes after factoring opportunity cost or alternative uses of the company's resources. For example, if a company forgoes a project project A and choose project B, then the economic profit would be the accounting profit plus how much more or less profit does the company makes by going for project B over a project A. Now that you understand the two types of profit, let's see the differences between them. So accounting profit versus economic profit. So accounting profit is a net income after deducting total expenses, or we can say it is an explicit cost from the total revenue. On the other hand, economic profit is the surplus after deducting opportunity cost and implicit cost as well. It gives a true financial health of a company, while economic profit may not give a true picture as certain parameters are estimated. So accounting profit tells the profitability of a company, economic profit on the other hand tells whether or not the company is efficiently allocating the resources. We can say economic profit may also include minimum payment to the shareholders to discourage them from taking back their capital. Other special item it may include residual value, inflation level changes and more. Accounting profit does not include any such thing. So for the formula for the economic and accounting profit, we, through which we can calculate. So the formula for calculating accounting profit is the total revenue minus explicit cost. And for the formula for the economic profit, the formula is total revenue minus explicit cost plus implicit cost. Now the example for accounting profit and economic profit. Suppose suppose company A reports revenue of 3 lakhs and incurs explicit cost of 50,000. The accounting profit in this case is now the 30 lakh is our accounting profit, and 50,000 our explicit cost. Now we deduct the 50,000 from the 30 lakh, so we get the 2 lakh 50,000 is our account is our accounting profit. An example for the economic profit. Now if the implicit cost of company is 75,000 and implicit revenue is 30,000, in this case economic profit will be 3 lakhs, 3 lakhs plus 30,000 minus 50,000 minus 70,000 is equal to 2 lakh 5,000. Another topic for the corporate finance is compound interest. So compound interest or compounding interest is the interest on a loan or a deposit calculated based on both the initial principal and the accumulated interest from previous periods. So compound interest can be thought of as interest on interest, and will make a sum grow at a faster rate than simple interest, which is calculated on the principal amount. Compound interest is calculated by the multiplying the initial principal amount by 1 plus an annual interest rate raised to the number of compound periods minus 1. So the total initial amount of a loan is then subtracted from the resulting value. So the formula for calculating compound interest is equal to total amount of a principal and interest in a future or future value less principal amount at present or present value. So here P is our principal amount 1 plus I shows here interest rate whole power n, n is equal, n here shows a number of periods and minus P. So for example, take a 3-year loan of 10,000 at the interest rate of 5% that compounds annually. What will be the amount of interest? In this case, it would be 10,000 our principal amount and 1 plus 5%. So 5 divided by 100 we get a 0.5. 0.5 and n is equal, here is a 3-year loan, so here n is equal to 3 years. So we got like this 10,000 10,000 multiplied 1.157625 minus 1. So our answer is 1576.25.